defending the free market, and making the moral case for capitalism. The Justin Moore Show. Hey everybody, welcome to the Justin Moore Show. All right guys, so on September 2nd, we had the much anticipated U.S. job numbers come out for August. And they were 151,000 jobs were created in August. Now the experts out there, they were expecting 180,000 jobs at least to be created. And so we actually underperformed. And this is what a lot of people are waiting for. And this is what I brought up last week on the show. How there's Janet Yellen speaking at Jackson Hole. And a lot of people, the people were kind of mixed with her speech. And basically everybody was waiting for these job numbers to come out. Well, they're finally out. And they underperformed. And there was actually quite a few experts out there that were thinking, well, if we get a jobs number in August greater than 200,000, that the Federal Reserve probably has a good chance of raising interest rates in September. But now that, looking at the underperforming jobs number that came out in August, you know what? This is really putting a damper on the Fed going to raise interest rates because, as Janet Yellen said, it's really dependent on the data. Well, the data came out, and yeah, surprise, surprise. Now that is another thing about this too. When the Fed says that they rely on the data, they can keep pushing things off. It's like, well, no, we really wanted to raise interest rates so bad, but dang it, shucks, I'll be darn, we can't do it. And so, as I said last week's show, and I've been saying for quite a while now, the Fed is not going to raise interest rates in September, especially right before a presidential election. But could they raise interest rates in December? Yes, they could. Just like they did last year. Last year is the only time they raised interest rates was last December. So, and of course, at this point in time, we're supposed to be up over 1% now, which we're not. So anyway, also what came out with the jobs numbers, they actually revised numbers up in July. Yeah, actually July was a really good month for jobs. When it was originally reported, the jobs number was 255,000. And so, see, this is why a lot of people and this is why the Fed was really talking up the U.S. economy. It's like, whoa, 255,000 jobs? Man, we are in a recovery. Holy smokes. And so that's why they were expecting in August, hey, we go north of 200,000 again. Man, we're ready to raise interest rates, my friends. Well, that number was raised up to 275,000. Yeah, usually they revise numbers down, but they actually revised them up. But of course, the unemployment rate is still staying at 4.9%. Now, what I really wanted to do on this show is a few weeks ago, I was reading this piece from I was reading this interview that was done with James Grant. It's on some Swiss website. And the guy interviewing James Grant is this Chris Grisger. Now, this interview came out, it was August 22nd. Now, in case you guys don't know who James Grant is, this guy's a legend. He's a very respected guy, from guys on Wall Street. I know Ron Paul, he thinks very highly of James Grant. This guy has written an investment newsletter for decades now called The Interest Rate Observer. And I remember always seeing him on, as an expert on TV and so forth. But yeah, James Grant, he actually had a book that came out, I think that was last year or in 2014. I can't remember which, but it dealt with the forgotten depression of the 1920 and 21. And you guys have heard me mention that on my show. Talking about, hey, look, no one talks about that recession, which, was really just as bad as the Great Depression, but we got out of it in 18 months because the government didn't do anything. And so he wrote a book on that, which I still haven't read that book, but I really want to. So I'll get around to that at some point here. But anyway, with this interview with James Grant, I think he's very much an Austrian-minded guy. And the things he has to say about the economy, talking about negative interest rates, just all sorts of stuff I just found very fascinating, and I just thought you guys would get a lot from it. So what I'm going to do here is I'm going to, because the interviewer is asking the question, so I'm going to read the question. When I'm asking the question to James Grant, like I'm actually interviewing him here, I'll just put Jim and then kind of ask the question. And then right when I get done talking after the question, That is James Grant's response, okay? And so basically, I haven't counted. I kind of picked out a few questions from the interview here. I don't know. There's probably around 7. And I just really think this is some interesting stuff, and I just think you guys will get a lot from it. So let's just start off here. Jim, for more than 3 decades, Grants has been observing interest rates. Is there anything left to be observed with rates this low? Interest rates may be almost invisible, but there's still plenty to observe. I observe that they are shrinking and that the shrinkage is causing a lot of turmoil because people in need of income are in full hot pursuit of what little of yield remains. And this is a point I've made on my show numerous times. That the very visible problem with these 0% interest rates is that how do you get a yield? You're ready to retire. You want to live off of your savings. Well, I guess most people don't have savings, but how does a retiree make ends meet? Well, they have to engage in riskier asset allocations to make decent money. And so that's why you see a lot of people there's been a lot of investment in junk bonds lately, that sort of stuff. But anyway, let's move on to the next question here. Where do you see the biggest risks? And James replies, sovereign debt is my nomination for the number 1 overvalued market around the world. You are earning nothing or less than nothing for the privilege of lending your money to a government that is pledged to depreciate the currency that you're investing in. The central banks of the world are striving to achieve a rate of inflation of 2% or more, and you are lending certainly at much less than 2%, and in many cases at less than nominal 0%. The experience of losing money is common in investing, but where is the certitude of loss even before your check clears? That's the situation with sovereign debt right now. Jim, right here, he's explaining the absurdity of negative interest rates. And again, I've done this on my show. Like he just said here, he's pointing out the absurdity of the Fed is trying to achieve, a 2% inflation rate. And on top of that, we have negative interest rates, that you are locking in a loss. And if we look around the world, and I've used this statistic before as well, that looking at government debt, $13 trillion worth of government debt, government bonds, has a negative yield. Your $13 trillion worth of assets out there are returning a negative yield. And that really is. And that's why I've made the point several times in my show, hey, this is the end game right here, negative interest rates. Okay, now let's move on to the next question that's asked to James Grant. On a worldwide basis, more than a third of sovereign debt is already yielding less than 0%. And then James replies back, this is not quite a bestseller, but a very substantial book called The History of Interest Rates. It was written by Sidney Homer and Richard Sia. Sidney Homer is no longer with us, but Richard Sia is alive and well at New York University. So I called him and said, Richard, I've read many pages, but not every single page in your book, which traces the history of interest rates from 3000 BC to the present. Have you ever come across negative bond yields? He said, no. And I thought that would be kind of a major news scoop. For the first time in at least 5,000 years, we have driven interest rates below the 0 marker. I thought that was an exceptional piece of intelligence, but I noticed, however, that nobody seems to have picked up on it. Yeah, isn't this is crazy, right? This really is. Again, adding to the absurdity of negative interest rates. In over 5,000 years of history, negative interest rates have never happened because in a sane world, they could never happen. They can't. Only with the government monopoly on money can they get away with this. And with central banks running the show. But you know what? The central banks running the show, that's not going to go on infinitum. That's going to come to an end. And when the central banks lose control, guess what? A fiat currency is out of control. And that's why, at that point in time, that's why you need to have something of real value, real assets. Gold and silver come to mind. Precious metals that have been seen as money for thousands of years when there's been no such thing as negative interest rates. And here's the next question. Jim, so what's the true meaning of all this? In finance, mostly nothing is ever new. Human behavior doesn't change, and money is a very old institution, and so are our markets. Of course, techniques evolve, but mostly nothing is really new. However, with respect to interest rates and monetary policy, we are truly breaking new ground. And again, I'm in firm agreement here with James Grant. He's making the point that, look, economics doesn't change because human behavior doesn't change. Markets and money, they're old institutions. They've been around forever. Economics is economics. If I give a quick example here, people once thought, with the technology stocks in the late 1990s that, hey, these things, they are not in a bubble. Because look, think about that. The internet has changed everything. That's why we can have these crazy multiples, valuations of these companies, over, basically just insane valuations of a lot of these companies that we're selling that were part of the NASDAQ. And people rationalize it because, hey, look, with the internet, with all this new technology, there's going to be crazy productivity. And so we can justify paying for these extreme valuations for these companies. Well, guess what? We soon found out in the late 1990s, 2000, that boom turned into a massive bust. People lost their shirts. People who went all in, everybody in the late 1990s, everyone was bragging about, buying technology stocks. Oh yeah, I'm going to retire early, man. These technology stocks, they're taking off. And then we look at what happened with the housing bubble. Same sort of thing, and these bubbles are just, if you look at them, they keep getting worse. And that's why this next one, it's going to dwarf the housing bubble like that was nothing, all right? And this is exactly what I do on my show. The simple economics I explain on this podcast, how things really work out there. But in today's world, the things I talk about, I'm just like, I'm out of the mainstream over here. Like, this sounds crazy what I'm talking about. Oh yeah, negative interest rates are absurd. Well, no, people are talking about, we have the central bankers saying, yeah, we need negative interest rates. Yeah, we need to print a lot of money because we got to get this economy going. Like, that is insane talk. So that's why you guys come here. At least there's a little bit of sanity here on the Justin Moore Show, right? Yeah, we're doing what we can over here, but, eventually I think, followers of this show, people with our sort of mindset who actually understand what real money is, we will be vindicated. And, at that point, people who own gold and silver, we will, at the very, very least, we will preserve our purchasing power. Well, actually, I think, I think gold and silver will eventually turn into a bubble, just like it did in 1980. We're at the very end of it. Gold and silver, literally, if you look at the charts, go look them up. The chart goes almost vertical. And I believe we'll be in that situation again, which, buying at these levels right now, we would be at the very bottom of that graph. So there's so many gains to be had at this point. So we're still super early. We're still probably a few years out. And so take advantage and prosper from the idiot politicians out there who are destroying our currency, who will destroy the lifestyle of the quote-unquote middle class, of the poor. Those people will be destroyed outright. And it's these benevolent politicians. Oh yeah, Trump, he's got us. He's got our back. He's going to make everything great again. Believe me. And then Hillary Clinton, the crony herself, who's as corrupt as hell. And, I tell you, I can't get over that. It's amazing. Now let's before I really this train just goes off the tracks here. Here's the next question from the interview with James Grant. The financial crisis and the weak economic recovery likely have spurred the rise of Donald Trump. Why isn't the U.S. economy in better shape after all those monetary programs? And then Jim replies back here, I wonder how it would have been if markets had been allowed to clear and if prices had been allowed to find their own level in real estate in 2008. Central banks have intervened to quell financial panics for at least 200 years. For instance, in 1825, the Bank of England lent without stint and was not, as they said, over nice about the kind of collateral. That was a very dramatic intervention. So it's not as if we have never before seen the lender of last resort at work. But what is new is the medication of markets through this opiate of quantitative easing. Year after year after year, following the financial crisis, I think this kind of intervention has not only not worked, but it has been very harmful. Around the world, the economies are not responding despite radical monetary measures. To some degree, I believe they are not recovering because of radical monetary measures. Again, absolutely. I think Jim is spot on here. He's pointing out that the government intervention in the economy that was supposedly to fix the disaster we had in 2008, which again was caused by the government. I mean, the perfect analogy for our government is the arsonist creating fires all over the place, and then they also play the firemen. So it's like, oh gosh, we gotta go put out all these fires. It's like, you are the dopes who started the fires. So don't come to me acting like you're some freaking superhero when you're the one starting the fires. The government is the one creating all of these problems. And all the solutions to fix the problems is making matters worse. And this is what Jim is pointing out here. That all this quantitative easing, this money printing, this government intervention, all these regulations on the financial markets is making our system not more stable, like the experts and politicians want us to believe. No, it's making us a lot less stable. And this money printing is leading us down the path of Venezuela to total destruction of the currency. You guys remember when I had that episode talking about Venezuela, where, they were a first-rate country over there in South America. Well, here now they're living like a third world country over there in Venezuela. And they're experiencing massive inflation. This year, they're projecting inflation over 700%. Could you imagine living through 700% here in the United States? I know, it's crazy. It's hard to take that in. Hard to see that happening. Well, guess what? That's the way we're headed. And again, you want another example, look back, think about the Great Depression. How it was Herbert Hoover who decided that for the first time, the government needed a heavy hand in a recovery to get us out of that depression. And so what did Hoover do? Well, we had projects like the Hoover Dam, these public works projects, we had the NWA. Basically all FDR did when he beat Herbert Hoover for re-election, he just doubled down on what Herbert Hoover was doing. More government stimulus. And even going into World War II, we were still in the Great Depression. I mean, with the government intervening to quote-unquote get us out of the Great Depression is what prolonged the Great Depression. Heck, you never hear about in 1937 to 38, we had a depression within a depression. Yeah, you never hear about that. How is that possible when all this government spending is supposed to work? And when Herbert Hoover started his little stimulus plans and jobs bills, that was really Keynesian economics before it became called Keynesian economics. Because it wasn't until 1936 when John Maynard Keynes wrote the general theory. Okay, I think I just have a few more questions from the interview here with James Grant. Just really fascinating stuff. Jim, what's exactly the problem with the U.S. economy? Well, he replies back, there is another side of what we are seeing now. In America, certainly the Federal Reserve and bank regulators generally are heavy-handed in their interventions. I'm sure they have every good intention, but with their regulatory charges, they are suppressing the recovery in credit that takes place in a normal economic recovery, and in this particular case, after a depression or after a liquidation. And then again, he continues on talking about the financial crisis. The new rules with respect to financial reform have absorbed not only force worth of paper, but also the time and attention of legions of lawyers. If you talk to a banking executive, what you hear is that the banks have been overwhelmed by the need to hire compliance and regulatory people. This is especially bearing on the smaller banks. I think that's part of the story of this lackluster recovery. Monetary policy has been radically open in the creation of new credit, but it has been radically restrictive with regard to risk-taking in the private world. Again, absolutely. Jim, spot on, man. As the government consumes resources in the economy by spending lots and lots of money, that's now less money that the private sector can spend, right? Where does this benevolent government get all of this money to help the poor? Well, they have to take it. They have to rob Peter to pay Paul. And look, that's now less money that we can be generous with, and if we want to donate and help out the poor, if we want to grow our business, which that is one of the best ways you can help the poor, producing more goods. More goods are produced. We're more productive. We invent new things. That brings down the prices of things. That is the history of capitalism. How we've made goods that were once only available to the rich because they were the only ones who could afford them, where they make them cheap enough that now the average person can afford those goods. I mean, look at how the improvement of a poor person's life, going back, just look at the last 100 years. Could you imagine living in a world without electricity? Could you imagine living in a world without air conditioning? And living in, say, Texas, where it's over 100 degrees all the time, or, Las Vegas, and I was there for Freedom Fest. The 5 days I was there, the coolest it got during the day was 106 degrees. Could you just imagine living in that environment without air conditioning? No. But now the average person out there has those things. Refrigeration. Everyone's got a cell phone now. Look at how you can connect with the world. It's just our society has improved for the better. The average person's lifestyle has improved for the better because of capitalism. But here we have the government getting involved with all their regulations and the government spending money to somehow fix all these problems, to somehow get us into a recovery, when they're the ones actually hindering the recovery. Because when the government invests money, they invest for a political return, not an economic one. When I think about that, I automatically think of Hillary Clinton. All of her little deals, you think of her emails. If she becomes the next president of the United States, you can damn sure bet any investments she makes will be for a political return. The Clinton Foundation comes to mind. Oh, man. Oh, wow, the Clinton Foundation. They're getting donations from all over the world. Huh. Oh, wait. And Hillary Clinton used to be the Secretary of State. Huh. No conflict of interest there. No, not at all. No. Just keep looking the other way, my friends. But let's continue on with the interview here. So Jim is asked, so what should be done to get the economy back on track? And he replies, there are guides in history on how to do this. For more than 100 years in Britain, in the United States, and probably as well in Switzerland, the owners of the equity of a bank themselves were responsible for the solvency of the bank. If the bank became impaired or insolvent, they had to stump up more capital to pay off the liability holders, including the depositors. But over the past 100 years, collective responsibility in banking has gradually replaced individual responsibility. The government, with the introduction of deposit insurance, new regulations, and interventions, has superseded the old doctrine of the responsibility of the owners of a property. That's why I think we need to go away from government intervention and go more towards market-oriented solutions, such as the old doctrine of responsibility of the bank owners. Again, this was eloquently put by Jim. Banking before the government really got involved and really created a cartel, it was a lot more about the individual and the individual taking responsibility. The banking system today, it's a collective, just like Jim was pointing out here in his answer. With all these countless regulations out there and all the government guarantees of deposit insurance, like FDIC, individual banks, they don't have to be accountable. And let's not forget, since the creation of the Federal Reserve in 1913, we now have a bank of last resort, right? And so they have problems. They have liquidity problems. No problem. You got the Federal Reserve to back you up. Oh, they can, they'll print until we run out of trees. That's no problem. So that's why a lot of people don't really fear a bank run, because they can just print it. Well, when you lose faith in the currency, that's a whole nother matter. Now, let's see. I think I just have. Okay, so there's just two more questions I want to get to from his interview here. And again, this is James Grant being interviewed, and actually this interview that I'm reading from, on Twitter I'm gonna put this out. So if you follow me on Twitter at Justin Moore Show, you can actually read this interview for yourself, because there's some of the questions I'm actually not reading. But again, this is just really great stuff. And here he says, the question is, at least in the U.S., the Fed is trying to go back to a more normal monetary policy. Do you think Fed Chief Janet Yellen will make the case for another rate hike at the Jackson Hole meeting next week? And Jim replies back, Janet Yellen is by no means an impulsive person. According to the Wall Street Journal, she arrives for a flight at the airport hours early. And that's plural. So this is a most deliberative and risk-averse person. Also, as a labor economist, she's a more empathetic person. She believes what most interventionist-minded economists believe. They have very little faith in the institution of markets, and they don't believe that the price mechanism is anything special. They want to normalize rates, and yet they can always find an excuse for not doing so. We have been hearing for years now that the next time, the next quarter, the next fiscal year, they will act. So I believe what I'm seeing. None of these days the Federal Reserve, the federal funds rate will go higher than 0.5%. I can't see that happening. And so, as I started the show here, I was talking about the jobs numbers. I briefly mentioned Jackson Hole. The jobs numbers being what they were, it's definitely looking like the Fed will not raise interest rates in September. So it's yet to be seen. And I thought Jim's analysis there was fascinating. Kind of psychoanalyzing Janet Yellen. Hey, look, this is a very risk-averse person. She shows up to the airport hours early, and she's a labor economist. I mean, just fascinating stuff. I hope you guys are getting a lot out of this like I did when I read this interview. And I think he's absolutely right with Janet Yellen. She most definitely does not want to raise interest rates, even though she talks like she does. But she, again, as I've said so many times on my show, it's all about the Federal Reserve just has to maintain credibility. And they will do that even if it goes against like what a Keynesian like Janet Yellen wants to do. Because, you lose faith, and the people lose faith in the Federal Reserve and what they're saying. The game is over at that point, completely over. And so that's where we're sitting now. Okay, now this is the very last question from the interview, and I think it's a fantastic way to end. So, Jim, what are investors supposed to do in these bizarre financial markets? And he replies, I'm very bullish on gold, and I'm very bullish on gold mining shares. That's because I think that the world will lose faith in the PhD standard in monetary management. Gold is by no means the best investment. Gold is money, and money is sterile, as Aristotle would remind us. It does not pay dividends or earn income, so keep in mind that gold is not a conventional investment. That's why I don't want to suggest that it is the one and only thing that people should have their money in. But to me, gold is a very timely way to invest in monetary disorder. Wow. Again, fantastic way to end. There you go, my friends. This is what I've been saying, since I started my show back in September of 2014. So it's almost been exactly 2 years now. And you should protect yourself. Buy gold and silver. Before you buy mining shares, you should be in possession of the physical metal. I see that there's more upside in silver, so I'm definitely heavy physical silver. But then I've also, like you guys have heard me talk, I invest in the miners. The miners are up a lot this year. They're up over 100%. What's the metals up? Well, gold's up. As I've said before, there was a little bit of a pullback this last week or two. Actually, gold fell back this last week 3%. But then the miners, some of these miners were down more than 30%. So that's the thing. When you do buy the miners, keep in mind, if you can't take volatility, you should not be invested in the miners. Because, to come down 30% in 1 week, that is crazy. But then you have to look at it this way. Gold and silver have run up these last few months. It's been crazy. There hasn't really been a correction. So I think this is a very well-needed correction before we move up to new and hit new highs, new 52-week highs. And so, actually, if you guys decide to jump into the miners, like you guys heard that if you donate $50 to my show, for a limited time, I will be raising it to $75 if you want these bonus episodes. But my one bonus episode, I give you 2 stock tips. They're gold and silver stocks. And these stocks were up, just right around 30%. Well, they pulled back with the correction this last week, and they were down, so you were still up. If you bought when I recommended, you're probably up 19%. So for those of you who want to jump into these stocks, and this is a great time to jump back in. Because, obviously you don't want to chase these stocks up after they've been running up. But a nice little pullback like we're at right here, fantastic time. Jump in. Get those. They're extremely safe way to play the gold and silver market if you decide to invest in the miners. And again, these stocks I recommend, full disclosure, they are stocks I own. I also own several others. I also own junior miners. Junior miners are the most risky, and sure, could I recommend some junior miners on my bonus episode? Yeah, but they're just so risky. I don't want you guys, potentially, if you could lose all your money, but you also could make 10 times your money. I don't want to do that. So the 2 stocks I do recommend are an extremely, extremely safe way to play this gold and silver bull market. So if you're not happy earning 45% this year, if you own physical silver and you want to be up, say, 200%, I would recommend maybe diversify and put some money in the miners. So again, go check out my bonus episode. Donate more than $50 to my show. Just go to my website, justinmooreshow.com. Moore is spelled M-O-H-R. You just click on the little PayPal button there. And yeah, again, just put in $50 there. Donate to me. I send you the bonus episodes. You can listen away and let's make some money. Let's try to preserve your purchasing power here as the whole world is engulfed in negative interest rates. And the Federal Reserve will someday soon will announce QE4, which will be more money printing. And you know what will happen to gold and silver at that point? They will skyrocket. And so I think now is a better time than ever. Jump in to these stocks to invest. Put some of your hard-earned money into physical metals. Just protect yourself. And I guess I should make one other disclaimer too. Obviously, as I said before, don't invest your rent money into gold and silver stocks, the physical metals, that sort of thing. Don't do it. Use it with money that you don't mind, that you're not going to touch it for 2 years. If it's money you need in a short term, in less than a less than 2 year time frame, don't invest in gold and silver. Just don't do it. Even though I think you probably will double your money from a year from now. I think that no problem. You'll probably make several times your money just in the 2 years. Again, nothing is for certain, but I just, from how oversold gold and silver have been, because they've been in a bear market these last 4-5 years. Seriously, guys, I would consider it, because I can tell you guys everything I recommend to you guys, I have done so myself. And so, you know what, guys, this is all I have time for you today. I thank you guys so much for being here. I will talk with all you guys next week, and I'm looking forward to it. This is Justin Moore, signing off.